Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good day and welcome. I am Nick. We are glad that you can join us today. The debate rages between the bears and the bulls. The bears, their premise is that the markets drop, bear markets that is, drop in two steps. The first one, when monetary policy tightens. The second step is when recession starts biting and there's a contraction in earnings. The big debate, of course, is will there be a recession? How bad will it be? Europe's not looking good. You probably saw in the weekly market report, many believe that Europe's heading for recession, and also potentially that many of the Far Eastern Asia Pacific countries could go into recession because of continued pressure on China's economy from the residential property market, from the hard COVID policy there. And then, of course, the bears also believe that inflation will remain sticky even when economies slow down because of the very unique aspect this time round to high oil prices and food shortages emanating from the war in Europe. The bulls, on the other hand, believe that we're getting close to peak inflation, and that means very close also to peak hawkishness from the central banks. Central banks have really been front-loading monetary policy, very big increases initially, and then they can slow down pretty soon after that. The economic slowdown, according to the bulls, will be mild because of very good balance sheets across the private sector, generally speaking. That the recession at worst will just be 2 quarters and hence little slowdown in earnings. So that's the introduction. We're going to talk this morning a couple of quotes from corporate leaders in the US, and then moving on to asset allocation, a fairly bearish set of observations from Edison. They believe that inflation will be persistent even when the economic growth declines, and that means that central banks will have to continue to be quite tight in their monetary policy. And then after that, we'll turn to MRB, but they believe, interestingly and encouragingly, that inflation and policy tightening will soon ease up. We'll look at the outlook for the US economy, and then a bullish finish to my section this morning from JP Morgan Cazenove. They believe that the market bottom will occur in the second half of this year and that there'll be strong gains by year end. Looking at some of the corporate leaders, interesting quote from the CEO of Goldman Sachs, David Solomon. In my dialogue with CEOs operating big global businesses, they tell me that they continue to see persistent inflation in their supply chains. Another quote from Jane Fraser. She's a CEO of Citigroup. Little of the data I see tells me that the US is on the cusp of a recession. Consumer spending remains well above pre-COVID levels. Household savings are providing a cushion for future stress. The job market remains very tight. Corporate clients see robust demand and healthy balance sheets. It's highly unlikely to be a sharper downturn than others in recent memory. Then on the oil price, from Halliburton Chief Executive Jeff Miller, I believe that oil and gas market fundamentals still strongly support a multi-year energy upcycle. From a demand perspective, oil and gas remain a critical component of long-term economic growth. Moving on to the asset allocation segment. First of all, the bearish outlook from Edison. They talk about the two steps in the bear market. We've had the first step driven by monetary policy and rising long and short-term interest rate expectations. The second step, investors have started to discount the consequences of a sustained period of tighter monetary policy. A meaningful economic slowdown is evident, both in purchasing managers' indices and a sharp decline in consumer confidence in the US and UK. Industrial commodity prices have been under significant pressure as growth expectations for 2022 are scaled back. Equities are now at risk of a profits downgrade. And then on inflation, while central banks are almost assured of engineering a slowdown, we fear the impact on inflation may be elusive. With war-related global supply chain challenges in food and energy, inflation may be more resistant to interest rate increases than originally expected. So when should investors start dipping back into the market? According to Edison, only at the final step, when forecasts for economic growth and earnings reach their low point, should investors start to bet on recovery. Portfolios should in some respects be detuned in order to be robust. With a wider than usual range of possible economic and monetary outcomes discounted in portfolio construction. On MRB, this is what they've got to say. If a recession develops in the US, we expect it to be very short and shallow, given the strength of household finances, liquid corporate balance sheets, the well-capitalized US banking system, and the tight labor markets. Moreover, key industries such as housing and autos would be entering a downturn from positions of strength, with low inventories likely to limit the scale of the output declines in these sectors. Corporate pricing power also remains very strong and should cushion some of the negative impact of declining volumes on corporate profitability. The hit to earnings in a mild recession would likely be more modest than the steeper declines witnessed in many of the past economic downturns. And then, of course, we did in fact in the first quarter have an economic contraction. It is important to note that real GDP contracted in Q1 due to slower inventory accumulation, a greater reliance on imports, and a drop in government expenditure. If one looks at real final sales to domestic buyers, then all indications are that we are far from a recession. Real final sales to domestic buyers increased strongly in Q1 by 1.9% annualized. So we're going to finish off with some rather bullish comments from JP Morgan Cazenove. They say that while US inflation increased from 8.6% year on year to 9.1% in June, the effect of that is that the call of peak Fed hawkishness is delayed, not broken. And we're expecting that in the second half of the year. This is given that money markets are now fully pricing a Fed rate at 3.6% by year end and 4% in the first half of 2023. So given that that is fully discounted and a rate that is already meaningfully above neutral, headline inflation also is likely to show sequential easing as we move through the second half of the year. So in other words, really bad news has already been discounted by the markets. We see global growth accelerating from 1.3% in the first half of this year to 3.1% in the second half. Similarly, we see global inflation declining from a 9.4% annualized rate in the first half to 4.2% in the second half. That is a very sharp slowdown, which would allow central banks to pivot and avoid producing an economic downturn. So that's it from my side, Gielie. I think there have been quite a few business developments on the local side of the markets.
Hi, Nick. Yes, thank you very much for a very interesting and comprehensive macro overview. Yes, yesterday was a very busy day in the JSE. There was lots of SENS announcements, and one analyst actually said it's the busiest day he's ever experienced on the JSE. The companies that we hold were not so busy. Anglo American, they reported production declines in the June quarter. Just to summarize, all the metals were down. Copper was down 21%. Iron was down to 8%. Coal down 12%. Nickel down 3%. Platinum down -2%. Diamonds down -4%. There's nothing that we can do about that except buy diamonds. Anglo American Platinum, they actually only July at the moment, but they brought out financial results till the end of June, and the earnings per share decreased with 42.5%. That's nearly 50%. It's a massive decline for Anglo Plats. Grindrod, Allocation Asset Management announced that they now hold 5% of the shares of Grindrod. And Grindrod also announced that they've appointed a new CEO. He is Mr. Zolani Mabambo. He will replace the present CEO, Andrew Waller, at the end of the year. Mr. Mabambo is an internal appointment and is normally a very good sign. He's very well qualified. He's a chartered accountant that he also studied at Harvard. Mr. Price announced that they've granted the CEO, Mark Blair, a bonus of no less than 33 million rand. It won't be cash, it will be shares. President Cyril Ramaphosa, he announced new emergency measures to curb our electricity problems, and it was actually very well received. The energy expert, Mr. Chris Yellen, said it's extremely good news